We didn't have the best day in the market. As we can see right across the board, there is a lot of red, although you could argue this is expected with earnings season taking shape. Very large names that have reported and that will be reporting over the next few weeks. But today our focus is on CVS. Now, they haven't reported their earnings, which is due in fact in November, but in the pre-market right now they are down more than 11%. So we're going to take a look and see whether or not this should be one for serious consideration. It will trade towards its 52-week lows when the market opens, and that forward yield will be sitting now well above 4.2%. So let's see what has gone wrong, and we can see the headline talks about the CEO being replaced as their profits and their share price have been suffering. Now, that isn't the only thing that we have heard in fact from this company, but they also now expect their EPS to be around $1.05, $1.10 in the latest quarter. And as we can see, something that pretty much the majority of companies in this industry have been suffering with are those higher medical costs, and we can see that has increased their medical benefit ratio 95.2%. That isn't something to be proud of. In this industry, the benefit ratio needs to be lower. We also want to highlight how they performed in their last earnings in August, and it wasn't great. They did slash their profit guidance. They did talk about how they will be cutting quite a significant amount in expenses, so they do want to become a lot more profitable, and they have also cited that higher medical costs, as we have just seen, are going to continue to squeeze not just the company but also the US insurance industry that we saw in fact on this channel earlier this week with both ELV and UNH, and in fact we did see both of those companies also take a hit to their share price. Now, in terms of the actual numbers, they did in fact beat on the earnings per share, 183 versus 173. Their revenue was a slight miss, 91.2 versus 91.5. And we also note their bottom line was unfortunately lower, 1.77 billion for the quarter. As we can see, the same quarter for last year, 1.9 billion. So not looking too great. Whether or not this is a factor that you would consider very bearish for the company, that is something to consider as part of our valuation shortly. But as we can see, CEO being replaced and their earnings moving forwards is going to be lower than anticipated due to the higher medical costs. Now, over the year, it is going to be a lot worse than this when the market does open. Over the last 10 years, we can see you would be down 23% on your overall position. And if you were to include dividends reinvested, it might be up slightly higher. Nonetheless, over the last 10 years, a terrible performance. And you'd have to go back all the way to around July 2015 to see their all-time highs of $112. Right now, or in fact, when the market does open, they will be trading lower than half of that price. In terms of the forward yield, as we say, when the market opens, we do anticipate this nearer the 4.5% mark, and the forward PE will be lower, 9.74 currently. We do get one buy rating from Wall Street, a hold from Seeking Alpha, and a hold from Quant. Now, in terms of their earnings over the next 4 quarters, we can see it is already baked in that the next 2 quarters, they're expecting double-digit decreases to the EPS year on year. We note though over quarter 1 and quarter 2 2025, they are expecting the growth to suddenly come back. And when we do look at the previous 4 quarters, they have a 75% track record. They beat in the more recent one, which is good to see, but overall 3 out of the last 4 quarters have been better than expected. Overall though, in terms of next year EPS of 7.34, they are expecting growth from 2024, and this will ultimately lower the forward PE to 8.7. Now, we always like to look at the metrics of companies to understand whether or not they are worth considering. So let's dive in. Dividend safety score 80 does look to be safe. We'll touch upon dividend yield theory, but we do see massive undervaluation, and we can see based on the forward PE, the price will be lower. So this will be sitting in undervaluation territory. Nice to note here, 9.9% increase to the dividend in December 2023. And this is a company, as we will see, have increased the dividend at a fairly admirable rate. Now, it was just reaffirmed a few days ago that this dividend does look to be safe, which ultimately means a dividend cut is unlikely. Now, how do they perform in the last recession? So these are some key metrics from the 07-09 Great Recession. They increased the dividend, great to see. Above average growth, negative 2.5% when the S&P itself was negative 12. They outperformed the S&P, negative 38, as we can see the S&P negative 55. Nice to report that double-digit or near double-digit increase in December last year. They've increased it at least in line with inflation at 4% over the last 5 years, but as we can see historically, this has been a company that does increase the dividend at a fairly strong rate. And we do want to point out they've been increasing those dividends for the last 2 years, as they did have a period, as we can see, where they kept it flat. However, they have been paying a dividend for the last 27 years without a reduction. Now, when we do take a look at the forward P, as we mentioned, it will in fact be lower than what we can currently see given the drop. It will be below this blue line, which we can see it has been for the majority of the last 12 months, giving us an indication based on the forward P that this company is undervalued. Just remember though, we are going to look at our own valuation model shortly. So dividend yield theory, as always, shows us a company is undervalued when the current yield sits above the 5-year average. Right now, we get a severe undervaluation signal, 4.18 versus 2.9, and the forward P, when the market does open, this will sit below 9. Again, massive undervaluation based on this model, given the P on the 5-year average sits at 9.8, and we can see healthcare sector as a whole does sit much higher. So we have a lot of undervaluation with this company. Just remember though, we're not looking at any one of these models in isolation. Now, free cash flow, always the one we do target, given earnings is susceptible to manipulation by management through accounting. Below 40% is what we want for consumer retailers. This industry, below 40% is what we get every single year, 30% in 23, 34% over the next 12 months. So this is looking very good in terms of that sustainable dividend growth. Then we get to the free cash flow, where we want consistent increases over the long term. We don't get consistency. We also don't get increases every single year. But over the last 10 years, 5.17 to 8.09 is some nice growth. We do want to point out over the next 12 months, they are anticipating a drop to around 773. In terms of sales growth, well, 3 to 7%, 3 to 4 ideally at the bare minimum for any company you look at, just to keep up in line with inflation. This company has done pretty well. More often than not, they're hitting around the double-digit increase to their sales, 11% over the last 2 years, and even 7% on a trailing 12-month basis is still very respectable. Then we move on to the total sales for those that want to see the numerical format, and we note they have nearly tripled their top line, 139 billion to 357 in 2023. Now, shares outstanding, something we do like to keep our eye on, as we do want to see companies returning excess cash to investors. They've done it all. They've done share buybacks, they've done share issuances. In fact, 2014 to 2017, they were buying back shares. Then they increased it across the subsequent 2 years. In fact, continued it all the way to 2021. Only recently, they have been buying back a small number of shares. So we do want to point this out. Over the last 10 years, the share price has been negative and they have diluted your position. Not a really good point to be in for a long-term shareholder. Again, though, we are looking at this company in terms of investing moving forwards and not looking back. ROIC, we want to see 17% for this industry. Personally, as I always mention, 10% or more, just give us faith management are able to effectively allocate their capital. And whilst it has been very inconsistent, over the last 3 years, it's straddled around the 10%, something that we would like to see consistency, but again, not something we see in particular with CVS Health. The other thing we look at is their operating margin, above 10% for this industry. To be honest, we don't typically see this. This is a higher end target. We see around the 5% level that we're seeing today. But we want to point out, we do want to see operating efficiency with margins increasing. We actually get the opposite, 6% in 2014, 4% in 2023, 3% on a trailing 12-month basis. So again, it's not moving in the direction we want to see. Definitely something to consider. And the free cash flow margin, it straddles around the 6%, doesn't really get to our target. And in fact, from 2021, it has been decreasing. So as we can see, a lot of things we need to consider before jumping into this company. And as always, we will add our margin of safety so we are covered by any bearish catalyst we do believe. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization, below 3. Remember, this correlates to dividend safety, balance sheet strength. We notice here 2.94 in 2023, and in fact, over the last 10 years, it has been pretty high, in fact, near above the maximum we want to see. As always, the numbers reference the number of years it would take the company to pay off all of their debt net of cash on hand. We have to flag over the next 12 months, it is increasing or expected to 3.36. So definitely significant considerations for any CVS Health shareholders or potential shareholders. Now, we also want to point out we have released our latest free weekly article. We drop one every single Monday morning to your inbox where we take a look at what's happened in the market as well as undervalued stocks that we do believe deserve your attention for further analysis. So if you click on the pinned comment below, sign up, you can read these straight away. You'll also be able to gain access to 36 undervalued stocks for the month of October. We talk about the upside that Wall Street see over the next year. We also flag those that sit within our own portfolio. And this month as well, you can grab 22 undervalued dividend stocks that Wall Street themselves believe have the most upside out of the whole market. So click below, sign up, and you can read straight away. Now, continuing on with our analysis, few things we like to look at. Insider movement, well, 0.24%. We see around 195,000 worth of buys over the last year, but we do see a lot more selling at 2.3 million. And we do want to point out though, in the more recent quarter of Q4, we see no movement. In Q3, again, no movement. In Q2, a little bit buying. Q1, a lot of selling. So very relatively minimal movement in 2024. Full transparency though, we will show you the sells and the buys. The more recent transaction was on the 2nd of May, a buy by the director around $54,000. Again, we do believe buying a bullish signal, but one, the amount was very trivial, and two, it is fairly outdated. Whether or not you want to include it in your analysis, the information is there. Then we jump into the institutional aspect, 81% ownership, around 6.5 billion worth of sales over the last year. We see more buying, around 8 billion in the same time frame. However, we do notice in the more recent quarter, and in fact in Q2, so the last 2 quarters, institutions have been selling more than they have been buying. Now, should that influence your decision as an investor? It really shouldn't. This is just something we have as an added layer, something we do like to include, but please always do your own due diligence. Now, we have covered, in fact, their top line revenue growth. We want to flag here their bottom line net income, but just as a reminder, it has been increasing very nicely over the last 10 years in a pretty straightforward rate. As we said, nearly 3 times from 140 to 357. But when we flag the bottom line net income, we want to understand what is the theme, is it consistent as well? And what we see when we do take a look, it is very inconsistent on a year-on-year basis. We would have thought we would see increases consistently over the long term, but what we note is it has nearly doubled from 4.6 billion to 8.3. So top line, yes, may give us that consistency element, bottom line, less so. So again, another thing to consider. In terms of the health of the company, total cash versus total debt, as we saw, the net debt to EBITDA is around that 3 mark that we want to see as a maximum. Cash position, well, it has been increasing over the longer term, similar to their revenue, going from around 2.5 billion in 2014 to the latest quarter of 16.3. How does that compare numerically and directionally to their total debt? Well, we can see very significantly their total debt has been increasing very rapidly. No surprises why they're looking to do those cost reductions. 13 billion in 2014, 84 billion in the latest quarter. So definitely something to worry about with this company. In fact, their debt levels are very high in comparison to their cash, and their net debt to EBITDA is straddling around that 3 level. Now let's get into essentially some gradings. The first one, valuation, where they get an A+. As we said, when the market opens, this will be even lower. And what we notice, in fact, the sector median is much higher at 21, meaning if you are buying CVS, you are getting a 54% discount right now to the sector. Does it deserve a discount? You could probably argue and in fact be correct that it does. How much of a discount, and is this a massive market overreaction? Well, this pretty much tells you whichever valuation metric you use. In today's episode, CVS is trading at a very, very sizable discount. Then we get to their growth, where they get an F, so understandable why they should be trading at a discount to the market. 7% in terms of revenue year on year, pretty much in line with the sector. Moving forwards at 6.2%, the sector marginally better at 8.3%. And when we do take a look at the earnings per share, anticipated to grow at 4% over the next 5 years, as we can see the sector as a whole significantly better at 11.3%. Then move on to profitability, where they get an A+. Gross margin, very low for me. This would be a massive red flag indicator at 14%. We see here sector median at 58%. And then we get their bottom line at 1.99. I guess the nice thing to note here is that the sector is negative at 4.5. So at least CVS Health is in the positive. And we can see massive cash from operations on a trailing 12-month basis. 8.1 billion, much better than the negative 14 million from the sector overall. Now let's have a quick recap of what we've just ran through. So a buy rating from Wall Street, a hold from Seeking Alpha and Quant, A+ on valuation, F on growth with an A+ on profitability. Now, how do they compare against others in the industry? We have the Cigna Group as well as others which are very well known. And over the last year, it is negative 8%, the worst performing. As we said, when the market opens, it will be even poorer. And when we extend it to over the last 5 years, we notice here that again, one of the worst performing, only up 11%. Over the last 10 years, negative 2%. So this pretty much shows us if you are reinvesting those dividends over the last 10 years, you still wouldn't have the original amount that you had invested. So not great at all. Always remember though, past performance is no indicator of the future, and we also want to show you that the S&P 500 in this time has massively outperformed. When we look over the last 5 years, again we can see the outperformance, so you would have been much better off over the last 10 years just investing in the S&P, a low-cost ETF. But as always, it will depend now as we are looking to the future. Do you have confidence that they can outperform? And CVS also, no surprise there, does offer a much higher dividend yield. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So our intrinsic value of $72, we ran it through 3 models. The first one, we have Graham's valuation, ticker symbol, earnings per share, long-term growth rate, AAA corporate bond yield to give us the intrinsic value of $71, market price 56, so we have our first undervaluation signal. Now we didn't use this model, the multiples valuation, as this company does trade at a much lower P than the others, but we just wanted to show you in case some of you also want to include it. We have the P multiple of comparable companies, average P multiplied by the EPS of CVS to give us another massive undervaluation signal. We then move on to the dividend discount model with the average growth rate around 6%. We've gone a lot lower to be more conservative. Again, another undervaluation signal. And then we move on to the DCF model, free cash flow year on year, average growth rate at 9%. Now we want to be very conservative. We've gone for no growth at all at 0%. With the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, another undervaluation signal. Now remember, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for CVS Health or any others that you do desire. So our intrinsic value today of $72 is just the average of these 3 models, and as always on this channel we implement a margin of safety where we start off with 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, we'll buy up to $65. Then we keep going till it's near the current trading price, and we can see in today's episode, it isn't at the 25% MOS level just yet. It may do when the market opens. Right now, you are getting at least a 20% with an acceptable buy up to 58. And as we can see, Wall Street do give this a price target of $70. They see upside of 25% over the next year. Now give us your thoughts below. Is this one you are looking to consider in the portfolio? Maybe it's one you've recently sold, or you are looking just to hold for now and getting in that very nice yield. For me personally, this is one I am looking to avoid. As we already ran through, there are some significant red flag indicators, and I don't believe over the next 5, 10, 15, 20 years, this will be able to outperform the S&P. So if you don't have that confidence, there's no point in considering an individual company in your portfolio. As always, if you've enjoyed the content, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter by clicking on the pinned comment below and joining us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.